So, Priya, if you don't mind if I start with you, we keep saying this, the 50 basis point hike expected, kind of already priced into the market. But you also believe that the Fed's goal of controlling inflation and also maintaining economic growth, it may be impossible. Is that why we're seeing so much volatility? Is that the markets are trying to figure out if the Fed and Powell can do the impossible?
Absolutely. I think the Fed doesn't control a large part of inflation. There's a lot of supply chain issues with goods inflation. There's high commodity prices. There's the impact of the war. These are things that Fed rate hikes or even QT really have very little impact on. There are also lags to monetary policy. So if the Fed wants to get inflation down to target this year or next year, they're going to have to raise rates significantly above neutral. Now, the market's already pricing that in. So I think the rates market is pricing the Fed overshooting neutral plus tightening policy through QT. And I think the broader market is just waking up to the fact that if the Fed indeed does what the rates market is pricing in, I think we're in for a really tough time for the economy as well as financial conditions. Now, our view actually is that closer to year end, the Fed might indicate some tolerance for higher inflation, because I think they're going to, when they start to see the impact on financial conditions or growth, that they actually slow down their path of trying to get to 2%, and they don't go much above neutral. But if the bond market is right, I think then we're in for a really tough time for the economy.
Wow, even tougher than now. A lot of volatility already, Priya. Stephen, over to you. So the RBA, it hiked rates a little bit higher than expected in an effort to tamp down inflation based on what was a shock from your Australian CPI numbers. Here in the U.S., we've been a whole lot more than shocked. I think we've been shocked and awed by some of the inflation that we're seeing. Do you see the RBA's decision impacting our Fed's decisions and possibly creating a more hawkish tone? Because, and I don't know if you have a consensus opinion, contrarian, but you actually believe even with this hike that the economy is going to continue to grow strongly.
Well, I think we look at it in the context of what happened in Australia today. So, the Feds raised rates, Canada, the UK, New Zealand. So Australia joining that club, if you like. With a 25 basis point move today, the consensus was actually for a 15 basis point move to try and get back to around 25 basis points. But we're now at 35, 0.35% for the cash rate. We actually think we'll get another 25 basis point moves over the remainder of this year into early next year. So that'll take the cash rate to 1.6%. But the bond market, similarly to there in the US, is pricing in the RBA cash rate getting to 3.5% over the next year and a half. We just do not see that happening, because if that was to happen, that would have a significantly negative impact on the economy, particularly the housing market here in Australia, where we have a heavily indebted housing market and lots of fixed rate mortgages that need to be refinanced over the next couple of years.
Stephen, what I was actually referring to, whether it was contrarian or consensus, was your forecast for the Australian economy to grow at 4.7% for the rest of the year, even with the hike that you're seeing today. So one of the big concerns we have here in the U.S. is that the hike might slow down the growth in the economy. You don't feel that way about this initial hike, about the Australian economy? Can I ask why?
Well, so we're expecting growth this year of about 4.7%, but much slower next year. I mean, the Reserve Bank's forecast they published today for 2023 growth is just 2%. So a significant slowdown in 2023 after the impact of these rate hikes feed through the economy next year. So this year we've got quite a head of steam in the economy, a lot of momentum. The labour market, like there in the US, is very tight. The unemployment rate is actually the lowest since the early 1970s. We're beginning to see wages growth, which the Reserve Bank talked about today. So the momentum for this year looks pretty solid. Next year, would expect a slower rate of growth.
All right, Priya, turning our attention back here to the U.S. We just talked about it earlier today. The yield on the 10-year just crossing 3% earlier this morning, kind of hovering around there right now. You believe it's going to hit a high of 3.2%. How does that impact the market and even the Fed's decisions going forward on hikes?
So I think the 10-year is really about quantitative tightening. Now, the market's priced for the announcement tomorrow, but I think there are nonlinear effects. So as we get more supply, what quantitative tightening, what balance sheet runoff does is it creates more treasury supply. We have to find the marginal buyer for treasuries, and that's what's going to move those rates higher. Then that starts to constrain economic activity, because most people borrow at the 10-year point. So I think the move in the 10-year is ultimately what's going to end the hiking cycle, and the fact that it's driven by real rates. I think it's interesting. Much of the rise in the 10-year up until the last month was in inflation expectations. Now we're seeing real rates starting to rise. That starts to impact the housing market, starts to impact any interest sensitive components of the economy. But I do think there's a little bit more room to go because the supply hasn't yet started. I think there's an impact of that supply, which is why I think the 10-year could go higher. The market's very volatile. You talked about that because liquidity is not that great. We're trying to find that marginal buyer when global rates are rising. We could absolutely move a little bit higher, but I think it's unsustainable because then the economy starts to protest.
All right, Priya, I'm going to put you on the spot and give you the last word here. Obviously, the RBA raising rates higher than expected with the goal of controlling inflation. The U.S. and Australia, two very different countries, two very different economies. But do you see the U.S. Fed taking a page out of the RBA's book and maybe hiking those rates a little bit higher, being influenced potentially by this decision?
So I think they're probably going to go 50 basis point this meeting. I think, for every central bank trying to get to neutral, they're all trying to get there fast. So to that extent, that's the commonality I see between the RBA and the Fed. I mean, we weren't talking about 50 basis point hikes just 2 months ago. So I do think the central banks get to neutral fast, where I guess I would agree with Steve. I think going above neutral, now that's a much harder task, which I think every central bank is going to struggle with. How much more restrictive are they going to take policy, fighting an inflation that they actually can't control? So I would be with you in terms of being struggling to go much above neutral, but yeah, they really want to get to neutral very fast.